Good morning. I'm Gord Long with the Financial Repression Authority. I have Jeffrey Snider, Head of Global Investment Research for Alhambra Investment Partners, joining us today from West Palm Beach, Florida. Welcome back, Jeff.
Good morning, Gordon. Thanks for having me back. I appreciate it.
Jeff, I want to jump right in because you brought some really great slides, as usual, with you, and three subjects on them. But I'd like to talk about the forecast and what you see with earnings, the changes we're seeing in earnings, some of the distortions, and what's ahead.
Well, earnings are a tough thing to start with anyway because there's always this optimistic upward bias in them anyway. Every year, analysts are way overestimating what earnings are going to be on a given year. But in the last couple of years, that has been replaced by what was really a significant change in the entire earnings environment. If you go back to the middle of 2014, for example, analysts were expecting $144 or so in as-reported EPS for the S&P 500 for calendar year 15. And that was essentially the recovery story. That was the story that QE had told to the stock market. I think what stock investors were hoping to get at some point in the future. However, with this rising dollar period, earnings have since just collapsed. We didn't get anywhere near $144 in earnings in 2015. In fact, it was $86. So this opened this wide gulf between what the market was expecting to get and what it actually got. However, that hasn't stopped. It wasn't like a recession where earnings dropped quickly and then rebound very quickly. Earnings have still have not recovered. And so now we have for 2016, where earnings estimates are again coming down quite significantly, where I believe the latest estimates are for about $100 in earnings for calendar year 2016. So that's a big difference between, expecting $144 in the middle of June and only getting 110 2 years later. And so it leaves the market particularly vulnerable in a capacity of overvaluation.
Yeah, what's concerning me even more, not only is the top line falling off, not only the earnings falling off, but the cash flow is falling dramatically, and that impacts credit and everything else. And I haven't seen cash flows falling from my work at this rate in a long time. Now I'm talking about discounted free cash flow.
Exactly, and it gets back to I think the market in terms of expecting a much different environment for 2015, 2016 than what has actually been delivered. And that's always the vulnerability when the market depends upon primarily forward earnings. The risk is that forward earnings may never show up. And what we're finding is that they didn't show up in 2015, and that the risk that they won't show up in 2016 is high, and maybe even further beyond that. And so what is left supporting the market? And as you say, Gordon, without cash flow, there's no earnings, there's no cash flow. It's basically a high risk situation with valuations such that they are.
Well, I don't want to be exaggerated, but the only thing holding up the market to me has been excessive corporate buybacks, and that comes has come out of cash flow, but maybe even less degree. And it's been more borrowing. But it's tough to borrow when you don't have the cash flow to justify the credit ratings. It gets more expensive. So I don't know how long the buybacks can sustain themselves. I don't know if you got an opinion there, but to me, that's the big issue here.
Yeah, I agree. And I think it's, we talk about cash flow and earnings. It's not just the energy sector either. Let's be clear about this. This has become a widespread problem. The industrial sector, even telecoms, utilities, they've all had a bad run in terms of earnings and cash flow. And so, yeah, you're right. How long can buybacks continue to support a market where fundamentally it's a flawed premise?
I'm looking at the banks in Europe and we know what's going on in the Italian banks, et cetera, but even some of the German banks, London's, but loans to the shipping industry, and because the shipping is so slow and profits are getting hit and cash, some of the banks are in trouble with their loans to shipping. I mean, it's right across the board. I'm not trying to be negative, but we've had 4 or 5 quarters of falling revenues, top line growth and revenue growth, and it's like, but the market, at least the U.S. market, just seems to ignore it. At some point, reality's got to set in, you would think.
Well, at the very least, the market hasn't gone straight up again anymore. I mean, it's been mostly sideways for a couple of years, which just can help. it does appear stock investors are finally starting to pay attention to the world around them. And it's no longer just a world where QE is going to deliver magic. So there is some progress in reality. And I agree with you, Gordon. I think there's a lot of trade problems that are at the foundation of all of this. The fact that you talk about banks in Europe, there's a tremendous amount of emerging market exposure with those banks that has a financial element as well as an economic one. There isn't a support of a global economy that is growing in sustained fashion. So I think that accounts for a lot of the earnings drop off in the last couple of years, as well as the financial risk.
Yeah, well, I look at China's imports are down 17% year over year. I call that a hard landing. But those imports are all coming from basically the emerging markets and the commodity markets, so they're down. They have borrowed upwards of $9 trillion from the U.S. in U.S. dollars over the last 7 years, thereabouts, maybe it's 7 trillion. That's suddenly got very expensive for them. And there's a lot of European banks in there. So I think there's more pain here to come. But switching gears from earnings, that leads to currencies. What's your sense on what's going on in currency markets, and specific to the Chinese yuan? We've had 7 stealth devaluations in the last 60 days. And with capital flows coming out of China, investment slowing, they've got to do. My opinion is they got to do something with the yuan.
Yeah, and it's again tied into the whole global economy and the fact that the global economy is stumbling. The Chinese financial system is again short of dollars. There's always this dollar short problem. The rollover problem is predominantly a function of the global Eurodollar system. And so the Chinese have trouble because, let's face it, they're underneath a tremendous amount of economic pressure. And so financial firms that used to supply them dollars on a ready basis are a little bit reticent about continuing to do so. So that explains a lot about what the capital outflows look like. And it also explains why that we have these, what you call stealth devaluations, because what a stealth devaluation is in the wholesale term is it's allowing Chinese banks to more aggressively bid for dollars. And essentially that it's combined with the economic problem where you have less growth in China impacting less growth around the world, which again increases financial risk, which then gets rewound into more reluctance to lend more dollars into China and becomes a vicious cycle where the Chinese have no choice but to continue going in one direction.
Yeah, I think they're in a rock and a hard place here. And I'm watching them selling their their currency reserves to shore it up. But I'm also looking at the yen yuan cross, and so as the Chinese yuan has been falling, the yen has been rising in strength, and so it's the competition in China, Japan. That's a huge issue for Japan right now, as if it doesn't have enough problems. And I sense a fracture. I don't know how long they're going to, even Japan can go without devaluing the yen down, because it's been so strong here for 4 months.
Right, back since November, the yen has been strengthening. No matter what, it's amazing. Right, no matter what the BOJ does, the yen goes up. It's almost like a defiant move. And I think that's an important element to all of this, is that the markets are reassessing what central banks can actually do. The yen devalued going back to 2012 and the first whispers of Abenomics, long before the Bank of Japan ever even bought its first bond under QQE, because the market respected the fact that the Bank of Japan could do what it said it could do. And then you get it to the middle of 2015 in August last year, and it was a wake-up call that a lot of the myths or beliefs supporting the markets and the direction that they were in were challenged directly. China primarily among them. The big devaluation last August was a wake-up call that markets need to reevaluate how central banks actually fit into all of this. And what they find is that central banks aren't exactly as powerful as everybody believes them to be. And Japan is a perfect example of that because, again, now the yen goes in the other direction, which, the BOJ clearly does not want it to do. And no matter what the BOJ does to try to talk it back down, it's only moving up, up, and up. So, again, it fits in the entire paradigm of the economy, the financial risks, everybody reevaluating what central banks are actually doing that can actually be helpful. And there isn't a whole lot.
Yeah, there seems to be less and less options. But I know I look at Europe, and I know for years that the yen carry trade has been an important part in helping Europe finance itself. But you never borrow in a currency that's strengthening. So, and here we got the yen that continues to strengthen, and I feel Europe is going to be needing money other than just, I'll use the word printing it, but they're going to need more funding. I don't know where it's going to come from because I sense we've got a banking crisis again beginning to occur in Europe. Comments on that?
Well, yeah, and it's I don't know if we've got to a banking crisis yet, but that certainly is the indication of some of the bank stocks. But I mean, we talk about.
I'm referring to Deutsche Bank specifically there, by the way.
Credit Suisse too. I mean, both Deutsche Bank and Credit Suisse are down, 65% from their. I mean, some ridiculous number. That doesn't indicate anything good.
Well, it looks like a Lehman chart to me.
Yeah, and well, what we're talking about here, you see low interest rates all over the world getting lower every day. That is indicative of tight money conditions, and I think that's exactly what the problem is here. And we're talking about tight money. We're talking about tight wholesale money, tight dollars, tight euro dollar conditions. And it gets back to what we're talking about with Japan and the carry trade. The carry trade is really Japanese banks who have any number of yen they could ever want, to then have to swap those yen into dollars. So again, we get back to this dollar short issue. And so if there's tightness in the euro dollar market, there's going to be tightness in the carry trade. And it ends up exactly as you were saying, Gordon, where it gets, the shortness of monetary, flow, gets transmitted all over the world, whether it's Europe, whether it's Nigeria, whether it's Argentina, Brazil. It's a global problem. And that's why interest rates are coming down all over the world. It's like Milton Friedman said in 1998. It's the interest rate fallacy. Low rates aren't stimulative. Over the long run, if interest rates stay low, that is indicative of tight money conditions. And so under that paradigm, everything starts to make a lot of sense. Again, talking about what central banks have done and their role in all of this. Why is the market reevaluating central banks? Because they see central banks having quote unquote stimulated. Yet here we have these tight money conditions prevalent everywhere, and not just the financial system, but the real economy.
Do you sense we might have, I know we have a dollar shortage, but the semblance of a beginnings of a liquidity crisis here, or crisis too strong, but a real liquidity problem starting to loom?
Yeah, it's been on and off since June 2014. I mean, we've had discrete events. October 15th, 2014. You had the Treasury buying panic. That's a liquidity issue. It doesn't matter if it's buying or selling. When you have odd moves like that, that's a liquidity issue. You had January 2015. The Swiss National Bank was forced off its peg to the euro. Obviously in August and then again in January and February, we had more liquidation events. So yeah, there is definitely liquidity problem. It's not the same as it was in 2007 and 2008. There's a different character to it. There's a different feel to it. And there's a different, I think, pattern in how it's manifesting. But ultimately, it's the same thing. It's the fact that the dollar short is becoming much more of a problem. I think the difference now versus 2008 is that it's becoming more of a problem slowly, whereas in 2008 it happened all at once.
And you feel it globally, and that's what's most troubling. And big crises happen that way because it becomes so overwhelming as they wash ashore. What's most troubling to you, Jeff, when you're doing your research right now? The things that you're looking at.
What's most troubling to me is the fact that there aren't any answers to this. I mean, what I see is an unstable currency regime, and again, it's a global currency. That's why this is a global problem, and we are completely unprepared for it. Which there's really no excuse for this because we should have solved all these problems back in 2008 and 2009. But regardless, here we are in 2016 facing the same types of issues, and we have the same types of outlook because there is no solution that has been presented that would allow for a stable currency to take over from the euro dollar, which clearly doesn't work. So that's what bothers me the most is we're facing a very uncertain future again. And I think that's going to be increasingly part of the problem, part of the financial mix is rising uncertainty, especially as the myths about QE and central banks recede. usually creates a lot of volatility.
The central banks, and it seems like we're just trying to drive the world with monetary policy. We have more than that. We have fiscal policies. We have structural changes, which seem to be absent from the question. But central banks can fix liquidity problems generally, and we're talking about problems there, but they can't fix solvency problems. And what I'm seeing is I believe the credit cycle's turned, and I am really starting to, and I'm looking at non-performing loans right across the board in some of the banks rising there.
So we're talking about Italy again, right?
Yeah, and so I'm getting
consecutive year.
I see. So I'm seeing solvency issues that have been hit, and typically you can get out, but you just keep rolling over the money. But I'm not so sure the rollovers are going to continue the same way.
Yeah, and I agree. And look, central banks are, via John Maynard Keynes, focused only on the short run. The idea is that they'll, kick the can down the road, get everybody happy for a couple months, so that 3 months later the problems look much better. And so you can't do that forever because it doesn't ever solve the problem. The idea for QE, whether U.S., Japan, or Europe, was that it would kickstart a robust recovery. If for nothing else, because the Great Recession was so large, there should have been symmetry in the recovery. The recovery should have been just as large as the recession. So central banks, I believe, were counting on robust growth to solve the solvency problem, because you can wind down insolvent banks under a robust growth regime. And the fact that it never happened only makes it worse, because now you've lost credibility as well as economic support. So it makes it that much more difficult, which is, again, why we're talking about Italian banks yet again.
And then you have all the unintended consequences that come with 7 years of almost zero money. And we've yet to really understand that. And we certainly know we have a lack of price discovery. We know risk is, in my opinion, mispriced. So there's consequences that are looming. Switching gears, but maybe staying on this, Graham Summers has been... Lawrence Summers, I apologize, has been running around the world kind of preaching to anybody that's willing to listen, if I can use that, is that we need to have a globally coordinated fiscal stimulus program to really kickstart the global economy and get her back on, because the first time hasn't worked here. And he seems to be pointing it at in infrastructure spending, massive coordinated infrastructure spending to increase the central bank's balance sheets too. Comments on that? Have you heard it, or any observations?
Yeah, absolutely. And he's not the only one. And it's amazing that we actually get to, that this stuff is taken seriously, because it's basically, fiscal policy was one of the original responses to the Great Recession. That didn't work. And so that gave way exclusively to monetary policy. Now we've realized that didn't work. So we're going to go back to fiscal policy again. And so we'll just trade back and forth as each one doesn't work. Hoping that everybody forgets that fiscal policy didn't work last time. I don't think that's a coherent policy at all. I think it's grasping at straws. And I think, frankly, that's where we are. Policymakers and economists have run out of ideas. And so they're hoping that people have forgotten that we tried this already and it didn't do much, except waste a lot of money. The problem is, again, that they keep trying to do these things. If they would stop, then maybe we'd have a chance of success. As you alluded to earlier, price discovery is completely absent. So how can you have a recovery without price discovery? Resource allocation is the chief benefit from price discovery. Resource allocation is the lifeblood of the economy. And so the more we manipulate price discovery or completely obliterate it, the less recovery you have. I mean, that's not a surprising result. So, fiscal policy isn't going to fix it, just as we've learned monetary policy isn't going to fix it. And so we can expect them to continue to go back and forth forever until somebody intercedes.
Well, I know as we talk, Bernanke has made a quick trip to Japan to talk to Kuroda, and Abe. There's discussions in there. The rumors are they're talking helicopter money, but I don't know, rumors are rumors, but they're certainly talking about something, and it sounds a little desperate to me.
Yeah, and I think it's the idea that they're realizing the tight money conditions and they're trying to figure out a way to actually do it. Whether it's negative interest rates or helicopter money, they're both, to me, the same thing. They're both admission that QE didn't work. NERP is essentially trying to force banks to get QE to work, whereas helicopter money is just circumventing banks altogether. the idea is the same. It's the idea that there's a tight money environment and they don't know what to do about it. I think it's insane, either negative interest rates or helicopter money, because you're just making a bad situation that much worse. But yeah, they're running out of ideas, and they don't really know what to do in response. And so, desperation, I think, plays a big part of why markets are reevaluating central banks, because it's not like they're hiding it very well. It's very discernible.
Yeah, exactly. For us to watch it closely, it's exactly it. It's blatant now.
Yeah, it's this huge contrast, right? You know, you go back 20 years where Alan Greenspan was a genius and he didn't do anything. All he did was talk, and he made a career out of not talking. But yet, no matter what he did, he was taken as a genius. Whereas 20 years later, Janet Yellen sounds like a fumbling idiot. No matter what she does, even when she sounds partway coherent, she still sounds somewhat like she's desperate, because that credibility has all been blown away. It's all been erased because the Fed has been forced into action. And by being forced into action, it's proven what it can't do.
And now we have Greenspan singing from the rooftops the problems that are in front of us and the seriousness of the
Right.
issues. And I've never heard him quite that strong before. I didn't mean to keep us on a kind of a negative tone here today, because there are a lot of positive things out there, but certainly unless we address some of these problems. And usually it takes a crisis to get change. Unfortunately, crisis doesn't get necessarily the right change. Anything we haven't talked about here, Jeff, that you want to raise with our listeners?
I think, we need to look at this as an opportunity. Maybe not in the short run, but the long run. There's an opportunity here, especially now that some of the central bank myths, some of the orthodox economic myths are coming apart. Their hold on the collective imagination and on the political system is probably as low as it's been in a long, long time, which opens the door to credible solutions. And I think, Larry, you talked about Larry Summers earlier. His theme is secular stagnation, which I agree with, but for different reasons. I believe the economy has been permanently altered into this decrepit, low growth state. I think that's a monetary phenomenon. And so if we open the door to credible solution, there is an opportunity, if done correctly, for tremendous growth. We've had 15, maybe 20 years of at least deviated growth, deviated economic resources, suppressed economic instincts that if reborn under terms of stable currency, stable financial system, I believe could unleash some very powerful growth. So I think there's an opportunity here, unlike what was in 2008, because of the fact that central banks have essentially almost, not quite, but almost taken themselves out of the game. Economists have taken themselves out of the game. And there's an appetite out there for real answers, for people who have knowledge of what is actually going on. Somebody who'll say QE isn't going to work again, no matter how big you make it.
Exactly. My sense is that 2008, I can say, was a financial crisis and everything that went with it. And we really, after that, through UK or what we saw in Europe, is we really had facing an economic crisis, and it has been economic, as we're seeing this tremendous global slowdown, etc. But now we're on the cusp where I see it next is political crisis of fringe parties gaining huge power. Brexit's a semblance where people, the anti-establishment, kind of voting against the status quo. We don't have to look any further than Trump and Sanders here, and the change in the primaries we've never seen before. There's a social unrest that's building where people are demanding some kind of changes. I don't think they can articulate what monetary policy or fiscal policy. They just know something's broke. Talk to any student today, unemployed with a student loan, and they'll tell you the system isn't working for them. Comments?
Those are good signs. I think it's the signs that people are fed up. We've taken it for long enough. The economy has not recovered since 2008. And people know it. I mean, it doesn't matter how we talk about full employment in the employment statistics. The fact of the matter is the economy is nothing like what it should be. People intuitively feel it. And so you're right. They're searching for solutions politically, socially. They may not know why or what the problem is, but the fact that they're actually searching is a positive sign that, maybe we won't be Japan and go through 30 years of this. Maybe there will be a reckoning at some point. At least there's an appetite for answers and an appetite for doing something different, which is a positive sign. But I mean, historically, this is pretty typical. Whenever you have a period of prolonged malaise, stagnation, depression, whatever you want to call it, it always leads to social upheaval. The trick is to figure it out before it goes too far. And, that's the great danger and difficulty here, especially when you're talking about fringe parties and political upheaval, is making sure it stays on a fruitful and productive path. It doesn't veer too far into the destructive. When we talk about creative destruction, there's always a balance there. We want more of the creative and less of the destruction. So, again, it's an uncertain future, but again, there's opportunity.
On that positive note, Jeff, could you tell our listeners how they could follow your work, the great research you and your company put out?
Yeah, I do. Everything I do, I post on alhambrapartners.com. It gets syndicated at various places like David Stockman's Contra Corner, Newsmax. I have a weekly column at Real Clear Markets and some other places around the way.
You put out some of the best charts in the business, so I got to compliment you, and I really enjoyed it.
I appreciate that, Gordon.
We'll talk to you again?
Yes, absolutely.
Talk to you. Thanks, Jeff. Bye.
All right, thanks.